Good morning, afternoon, or evening, everyone. I'm Bill Judge, the Dean of Fellows. We're delighted to have you here. We're kicking off this new webinar series with an exciting speaker, Randall Morck. Shelby Guy is our webinar coordinator. I will be kicking off this session. Randall will be presenting some very provocative ideas that I think you'll find interesting and important. And then we will conclude after a 45-minute talk with a Q&A period. If you have a question during the presentation, please forward that via the chat function to Shelby, as she can use that then to handle the moderation. Our first speaker today is Randall Morck. He's the inaugural fellow of the ICGS, and Jaruzelski, Distinguished Chair in Finance at the University of Alberta. From a blue-collar Canadian family, he won scholarships to earn honors summa cum laude in applied mathematics and economics at Yale, and then went on to earn a PhD in economics at Harvard. His research has been cited over 46,000 times. He's won 2 Journal of Financial Economics All-Star Citations Awards. He is a senior fellow and vice president of ABFER and a research associate with NBER. He's advised governments and multilateral organizations on corporate governance and other issues. It's with great pleasure I introduce to you Randall Morck. Randall, the floor is yours.
Thank you very much for this honor and privilege. I have great admiration for you, Bill, and for the society that you have founded, and you have my complete support in every way. So what I'd like to talk about is a different take on socially responsible corporate governance that I think arises from some new ways of thinking in finance that deviate a lot from traditional ways that we've thought about finance issues. And in these slides, I have not put in nearly all of the citations that I should put in because I'm drawing on literatures here, and I'm combining literatures, and there just are a lot of citations, and I just kind of can't do them all. So forgive me, please, if I don't cite you. There's a working paper, Kindleberger Cycles, that's available at the NBER and on SSRN. And if you see some citation that's missing and that's important, please let me know so I can include it in the next round. So corporate governance through the mid and late 20th century was largely in finance and economics based on Adam Smith and Milton Friedman's view that a corporation's objective should be to make as much money as possible. Maximize profits in finance, maximize the internal rate of return of the projects you invest in. And Friedman had a bunch of other stuff in that quote that's often not also quoted. The complete quote is a little bit more qualified while conforming to the basic rules of the society, both those embodied in laws and those embodied in ethical customs. And that qualification is going to be important. And then that is up against a second view of corporate governance, that the main task and objective for a business is not to generate extra income, but to act for the country, for the people. And this has come up in 2 rounds in the 20th century. Now that I'm old, a lot of the stuff that I've lived through has become history. And so now I find history interesting just because, like, I know a lot of it. So this view was actually quite prominent in the interwar period and in the period right after World War II. It's not a new idea. And it was prominent because dictators could tell corporations, I don't want you maximizing the profit. I want you to do what I'm saying and do it for the good of the whole people. And so even though this has become a leftist idea now, it actually historically, last time it was big, was a right-wing idea, which is sort of interesting. That's something I've learned in financial and economic history, is that the extreme left and the extreme right kind of swap ideas. And something that is extreme left in one generation can just pop up again on the extreme right side, and that's kind of interesting. But I cite Naomi Klein and David Suzuki for the left, and then I show a picture of Vladimir Putin to show the deeper roots of this idea. So how do we do this? Well, in economics, what we do is we say firms should maximize profit. And the profit in economics is usually the revenue minus a bunch of costs. And when we annualize that, we get something that's kind of like in finance, what we call the internal rate of return. So if you've taken finance courses or taught them, of course, you're familiar with that. And then we subtract from that the cost of capital, the return investors require. And so there's a profit rate, the IRR minus the cost of capital. And you want to do stuff where that profit rate is positive. And then in corporate governance, in finance, we say good corporate governance is do all the projects with the IRR greater than the cost of capital. And that's, again, something that's in all the textbooks. And that sounds like an unusual achievement in academia. You've got two different courses not undermining each other. And that's interesting. But what happens next? Well, the problem with what happens next is that in economics, we say, but in a perfectly competitive equilibrium, I cut my prices so that I can steal your customers, and then you cut your prices to steal my customers, and our IRRs fall until the IRR is equal to the weighted cost of capital. In a perfectly competitive equilibrium, profit is zero in economics. And so how do we deal with that in finance? That sounds like there actually are no IRR is greater than cost of capital projects in a competitive equilibrium. Well, what we do is we make economics a prerequisite. So when the students come to take their finance course, they're done with their economics exam and they've forgotten all that stuff. And then we just tell them, go out and find projects with IRR greater than cost of capital. And this is kind of more usual in academia. Sorry, let me just get rid of that. Apologies.
Call from Morck.
Okay, sorry. That's more usual, and that's kind of what we're used to. And the first person to notice this was actually Karl Marx, or at least it was if you believe Joseph Schumpeter in his History of Economic Analysis, and also in Capitalism, Socialism, and Democracy. What Marx says is that, according to Schumpeter, is that this is actually real. And so what happens is corporations compete until their profit rate, he calls it surplus value, is down to zero. And then in order to get that profit rate up again, what they do is they oppress workers. They push down salaries and worsen working conditions and lengthen hours. And that gives them an IRR above their cost of capital again. And then they do that again, and then they compete again, and the IRR falls again. And then they just repeat that circle over and over. And in each cycle, the workers get more oppressed. And according to Joseph Schumpeter, this is what Marx said. I've tried reading Marx. He's very hard to read. In English, he makes no sense at all. In German, I read some German. He's actually worse, I think, in German. I don't know how he is in Chinese or Russian. They seem to take him more seriously. But anyway, that's Marxist corporate governance. And basically, you want to oppress workers and stuff. And you keep on doing that until the workers of the world arise and unite and destroy capitalism and replace it with a real world utopia of international communism. And that is not observed empirically, I think it's fair to say. So what's really going on? Well, the reason Schumpeter takes this view is that he wants to point out that there are two kinds of competition. One is the Adam Smith, Milton Friedman competition, where you cut prices to drive profits to zero and compete to give customers the best deal possible. But Schumpeter says there's a second kind of competition to innovate first. And so if I come up with a better smartphone than yours, I don't have to lower my prices to steal customers away. I can even raise my prices and you'll still buy my smartphone because it's better. And so competition to innovate means that you can steal your rival firm's customers and keep the profit rate positive. And Schumpeter says that's what keeps capitalism going. But the downside is that this often involves disruptive innovation, what he calls creative destruction, and creative innovators profit by stealing other firms' uncreative firms, businesses, and that kind of destroys partially or completely those other firms. Innovation is disruptive, and people whose skills and capital are being destroyed fight back, and so innovation can be very unpopular. And so where does finance come into this? Well, this is where Schumpeter sees the social purpose of finance. And I want to talk about that because I worry about my own field, finance, having kind of forgotten about our social purpose. A lot of people in finance think our social purpose is to go out and find a way to get 0.25% more on a portfolio than the next guy can get. And that's not what Schumpeter sees. Schumpeter refers to intergenerational inheritance of traits. And this is Sir Francis Galton, founder of the field of statistics and noted eugenicist. So he's kind of, I probably should cancel him and not talk about him, but what the heck. What he did is he invented the whole idea of the linear regression, which we use all over the place in economics and business schools. And the idea, the reason he calls it a regression is that the trait of the child, so for instance, the height of the child is going to be a weighted average of the height of the population average plus with the average height of the parents. And so the child's height, if you've got a child if you're very tall, then your child is going to be taller than the population average, but not as tall as you, because it's a weighted average of the two things. And he called that the regression to the population mean, which is why we still call this statistical technique regressions. And whether that's genetic or epigenetic or environmental, I mean, the right thing to say is it's environmental, so I'll go with that. Regressions to population mean in intelligence also are apparent. Galton saw this, and this has given rise to the bell curve and all sorts of very controversial stuff that's really only controversial if you insist that it's genetic, which I do not. But basically, if you run child IQ on parent average IQ, and then you get that the child IQ is 40% the population mean, which is 100, plus 60% the parent IQ. And what that means is that if you're really smart, your children will be smarter than average, but probably not as smart as you. And the good news is if you're really stupid, your children will be stupider than average, but not as stupid as you are. And then there's this big noise term on the end, which means you get really smart and really stupid people popping up in families all over the place. But what that means for Schumpeter is that intelligence runs unreliably in families. And so many very, very smart entrepreneurial geniuses don't have family wealth. And many people with a lot of family wealth don't really have a lot of creative, innovative entrepreneurial smarts. And so Schumpeter says that's where finance comes in. That's the social purpose of finance. And so in his PhD thesis, Theorie der wirtschaftlichen Entwicklung, he distinguishes entrepreneurs from capitalists. Entrepreneurs are people with tons of ideas and no money. Capitalists are people with tons of money and no ideas. And the purpose of the financial system, there's JP Morgan in between Thomas Edison and a faceless rich guy. The social purpose of the financial system is to connect them. And so historically, what JP Morgan would do is every spring he would sail to Europe with tons and tons of printed stock certificates in US companies, including Edison General Electric. And then he'd come back in the fall from Europe with all sorts of gold and specie from rich Europeans, which he would then give to Thomas Edison to make light bulb factories. Next spring, back with the dividends to pay out to the Europeans, sell even more shares, bring back even more money, more dividends back to the rich people. And this is what Schumpeter calls the circular flow of capital. And Schumpeter says the social purpose of finance is to make this circular flow of capital work, to make it big and to make it accurate, so that the money flows to the people who actually have the creative IRR is greater than cost of capital ideas. Okay, so that's great. Now let's go back to economics and finance and corporate governance. So this is Robert Solow, and he's one of the most interesting economists of the mid-20th century. Economists really love these things called production functions. If you've ever taken an economics course, you've seen these production functions popping up all over there, Cobb Douglas and their other things. And what Solow wanted to do is he wanted to know, what does a production function actually look like? And so he got data on GDP and capital and labor and inputs of different kinds. And he tried to run statistical tests using data for the US for a period to estimate what's the shape of this production function. And then going forward, he'd plug in the US capital and labor and other inputs, and he'd predict what the GDP should be, and then he'd compare it with what the GDP actually was. And what he found, and what other people have found subsequently, is that production functions really don't work. They work terribly. They undershoot actual output dramatically. And the more you go out into the future, the more they undershoot actual output. So this is the GDP, the production function predicts, given this capital, labor, and inputs, this is the actual GDP. And what Solow finds is that more than 80% of total GDP growth is unexplained. And he calls this the Solow residual, or other people do. And what this was a big issue. This was originally interpreted as production functions just don't work. And then Solow himself argued, no, that's not the way to think about it. What's actually going on is production functions are always getting replaced. You've got a production function that uses a certain technology to use a certain capital and input to make certain outputs. And then there's an innovation. There's new technology, and you get another production function that makes more valuable stuff out of the same inputs, or that makes the same outputs out of cheaper inputs. And so we're always over time replacing production functions with new production functions that are more productive. And so technological progress, in Robert Solow's view, and this is, I think, now the consensus in people who study productivity and economic growth, technological change is what makes rich countries rich and keeps them rich. It's not more capital, it's not even more resources, it's new ideas for better and more efficient production functions. So Schumpeter is not just right, he's seriously right. He's right in a really big, major way. And you can see this with a bunch of different measures of innovation input. People in this literature use research and development, measure different ways, patents, different measures of patent importance. And they look at the patents in an industry or in a country, and then they relate that to measures of the growth in the Solow residual, total factor productivity, multi-factor productivity. These are all concepts that are trying to measure how big is that residual, how much is it growing over time. And so here's the growth in the Solow residual for different countries. Here's mean private sector R&D. And there's a fairly distinct positive relationship here, and some really strong outliers. Korea is way up there. And so this is kind of the basis of a whole new field in economics called endogenous growth theory. And it's also what, when you're asked to do studies for the government, they're always interested in how can I make my country more productive? So this is a bunch of studies for the Canadian government, but if you look at your country's government, I'm sure you can find an equal number of papers all trying to find government interventions to improve productivity. And that's what they're after. So why is this the way things work? Well, it works because innovation has really, really big positive externalities. When my firm comes up with an innovation, very often that's profitable for my firm, but it also is hugely profitable for all sorts of other firms that can just use my innovation to do stuff. So that's called a positive externality, when what I do has really good spillover effects to help you do things better too. And so a really good case study, which I won't go much into, but which is used in a lot of business school courses, is Walmart. So IT firms came up with a personal computer and they made money off that. They had a positive IRR from selling computers, or at least some of them did. And then here's Walton's before personal computers. It was this one little store in Arkansas. And they figured out how to use personal computers to control inventory and logistics and shipping. And they came up with this very complicated, specific computerized system for getting goods to where stores needed them. And they were able to swamp Woolworths and Kmart and other stores that were kind of previously their peers, because they could just get the stuff to consumers better because they had a better production function with lower costs to get the same goods to consumers. That and other spillovers from the personal computer dramatically increased the productivity of most Western countries in the late 90s and early 2000s. And that was positive externalities of innovations in one industry really affecting how all sorts of other completely unrelated industries could increase their output using the same inputs. And so this is a really big deal. And historically, if you go back, and so Joel Morck does this, and Bill Janeway does this, David Landis, Jeff Williamson, you go back and look through history, what you find is periods of prosperity are periods of really strong innovation. And if I had more than 45 minutes, I'd stop here and I'd go through a bunch of these and talk about them, but you can read about that by going to some of these people whose work I've mentioned. So how do we quantify this? Well, what people in productivity do, so this is data from a paper by Nick Bloom and co-authors, and it's consistent with data from Bronwyn Hall and co-authors, and the most recent paper on this is by Larry Summers and Ben Jones. And what these people do is they try to look at the R&D being spent by firms, and then they try and figure out what's the IRR of that for the innovating firm, and then who else picks up that innovation and what do they do with it, and they get a social rate of return that includes not just the returns to the innovating firm, but the returns to all the other firms like Walmart that use other firms' innovations to improve their own production functions. And what you get is really, really remarkable. So the first person who noticed this was V. Grillicus way back in like the 1970s or even earlier. And it's been reproduced and reproduced and reproduced. And the most recent one is this paper by Summers and Jones. But basically what you get is that this yellow band is kind of what we think is the typical range for the IRR of R&D by the typical firm. And that's kind of in the 15% or a bit less range. And then the green band here is what cost of capital is, and that goes up and down with interest rates and equity premiums and stuff. But basically what it shows is that R&D is positive NPV here in the 90s, and it's kind of zero NPV or barely positive NPV. But look at the social rates of return to R&D. Social rates of return of 80% per year for R&D of listed firms peaking in the 1990s and generally well above 60%. Where else can you invest in something and get a 60% return? Well, you can't, because it's not a private return that anybody can capture. This is a return to the whole economy, the global economy, because these things spill across countries too. And the reason I put up R&D by listed firms and all R&D is that there really is kind of a difference here. All R&D includes R&D at universities and government labs and other things like that. And what we find is that it's really the R&D by firms in stock markets that has the really big, high social return that creates all of these opportunities for Walmarts and other companies to increase their productivity. And what this says is that if we were really running our firms for the social good, we would do all R&D that's got a social rate of return that justifies its cost. And instead, we only do R&D that has an IRR that justifies its cost, because each firm is maximizing just its own profit and not worrying about other firms. And if we actually ran firms in a socially responsible way, we'd have firms doing like 4 or 5 times as much R&D as they do and losing money on it, and losing money for the public good. And you try having that conversation with the board of directors. You try telling them you should do lots of extra R&D because it's good for the country, it's good for the world, but you're going to lose money on most of it. That does not go over. And that, I think, is really kind of interesting. So that's why I see this as a corporate governance problem. Now, externalities as a corporate governance problem are not new. Externality theory goes back to Arthur Pigou at the very beginning of the 20th century. He realized that what one firm does, what one person does, can affect other firms or other people positively or negatively. And the big negative externality is one firm's pollution affects other firms negatively. The big positive externality I'm drawing attention to is that one firm's innovation affects other firms positively. And public finance theory is a whole big area of economics. A big part of it is about what do you do with these externalities? And the answer is you use Pigouvian taxes and subsidies. So you tax pollution with carbon taxes or cap and trade systems, or you subsidize innovation with R&D subsidies or government budgeted R&D. And you try to push the production of these goods down if there are negative externalities, push them up if there are positive externalities to get rid of these problems. Now, externalities get rediscovered by ecologists periodically. There was a big deal in the 1960s, and then again in the 70s, and again now. And one of the beefs I have with the ecologists is they just do not get this. So here's David Suzuki, one of the world's most prominent environmental activists. Conventional economics is a form of brain damage, dismissing damage to the environment as externalities, something left out of the economic equation. That's missing this whole subfield of economics that deals with this. And that's what Milton Friedman was talking about when he added these words to his quote, to his famous quote, that's generally not completed when people quote it, while conforming to the basic rules of society embodied in law and in ethical customs. Friedman's idea was what we should do is make laws that you can't pollute, and that would stop negative externalities. And we should make laws that if you do innovation, you get more money somehow. And so we have patents and copyrights and trademarks. And the whole idea is to change the laws and the customs of society to get rid of this externality problem. He thought that would work as a more general way of thinking about it than Pigou's idea of taxes and subsidies, but he was into that. And so corporate governance to maximize profits, do all R&D with IRR greater than K, and then you have rules and laws to keep your IRR down if you're making negative externalities and keep it up otherwise, or and to adjust governance for negative. Oops, what happened there? That's not what was supposed to happen. Yeah, there it is. So what we do to adjust for negative externalities is we've got CSR and ESG, and these are things that are studied in international corporate governance and in finance and in many fields, because it's a real thing. You create a lot of pollution, you destroy rivers, you mess up the air, you're going to have problems. Those are negative externalities, and so we're dealing with that. But you should do it on the other side too. And so what you should do is also, you should, if you take Vladimir Putin seriously, is you should run your company for the good of the whole country, the whole world, and you should do R&D with high social rates of return, even if it's deeply unprofitable. And that's a really hard conversation. I've tried to bring that up in board meetings, and you just get nowhere with that. They're willing to worry about pollution, but they're not willing to lose money doing innovation. But if firms ran R&D programs for the social good, corporate R&D would be over 400 times higher. And that's four-fifths of economic growth everywhere. So what do we do to try and deal with positive IRRs? Well, we do try to change the laws and the customs of countries to deal with this. One is intellectual property law, and that is increasingly becoming questionable. So here's Josh Lerner from Harvard Business School, one of the best guys in the world on intellectual property law. IT law has become an impediment to innovation. Why? Because there are patent trolls who go out there buying up patents, sitting on them, waiting for somebody to violate them, and then suing the bejesus out of them. And there are patent thickets. There are whole areas of medical research where nobody dares do research because there are so many secret hidden patents all over the place that you can't do anything without getting sued for patent violation. What else can you do? Well, R&D subsidies, but the problem is that really doesn't work that well. And in Canada, for instance, there was a huge scandal about R&D subsidies being stolen and being corrupt. And so there is kind of a problem that the best R&D subsidies go to the best red tape artists with the best political ends. That's a quotation from a leading economist at an NBER meeting. And since it was at an NBER meeting, I cannot give you the name of that person, or they'll drum me out of the NBER forever. And then you've got government labs and university funded R&D, so National Science Foundation and National Institutes of Health. When you try and relate that to solo residuals, the econometrics is really hard. And you could very easily conclude that university R&D doesn't really do much for the whole economy. And there's kind of two ways you could spin that. One is, well, we academics do research to impress other academics. Now that sounds kind of cheap, but if you think about it, it's actually true, because we do research that can get published. That means we have to impress editors and referees, other academics. We do research that will let us get grants in the next round of grants. So we're doing research that impresses academics on granting agencies. We're not necessarily doing the research that would help companies increase production and that would increase standards of living the most. Now, you can come back and say, okay, yeah, but the National Institutes of Health does research that improves health and life expectancy. That doesn't necessarily go into total factor productivity. And that's a very valid point. And then there's also the argument that universities do basic research that maybe doesn't turn into productivity right away or in 10 years or 20 years, but maybe it does in 50 years. And so we don't necessarily know that this research is useless, but it's harder to find statistically than corporate R&D, which has this nice relationship to solo residuals. So what's going on here? Well, I want to dump a little bit on my own field of finance and economics for a slide or two. When we tell a firm you should go out and do projects with IRRs greater than weighted average cost of capital, you can kind of do that. If it's a project you're used to, you know what the returns are going to be, you can kind of figure out what the IRR is going to be. But when you're doing research, really new creative research, you have no idea what the future prices are going to be, what the future amounts of production are going to be, what the future costs are going to be. And so what we tell people in finance classes is to solve the IRR, you just set this expression to 0. And that gives you the IRR. See, here's the IRR right there. You just solve that. And of course, there are hundreds and hundreds of unknowns you have to put into this equation, none of which anybody really knows. And there are probability distributions you have to put into this, none of which anybody knows. And when we tell shareholders to price stocks efficiently, we're telling them to solve that same equation and then figure out how much of the IRR is going to be paid out in dividends every year so they can price stocks. And so that's kind of high expectations about what we think firms and shareholders can do. But if you're in the government, what do the public finance guys think the government will do? Well, to solve for the social rate of return of an innovation, to decide whether you should subsidize it or not, you just solve a very similar equation, but with a whole bunch of new variables in it about the different externalities that are going to come out of whatever this thing is. And that's a really hard thing to do. So you have to kind of be lenient in condemning government officials who have trouble allocating subsidies, because that equation is not easy to solve, because most of the stuff that you would plug into it is not just unknown, but probably unknowable. And then voters, of course, in public choice theory, just solve the same equation and then vote for the politicians who do the right thing. And to economic theorists, this is easy, because all they do is write down the equation and then walk away from it. But if you're a graduate of an MBA program or you're a graduate of a public finance program working in a corporation or a government, you actually have to figure out what numbers to put into those things. And there really are no numbers. There are hundreds of unknown variables, and we have no idea what to do with them. And so what I've been suggesting in some of my papers is that there is a concept in mathematics and computer science called a transcomputational problem. You can prove that the problem has a solution, but you can also prove that there's no way of ever finding that solution, because in computer science, if you built a computer to solve it, the computer would require more material that is in the galaxy, and it would take longer than the expected age of the universe to actually solve the equation, for example. So that's a transcomputational problem. It has a solution, but there's no way to get the solution. Grossman and Stiglitz have a series of papers in finance journals where they talk about procedural rationality. Procedural rationality means not that you just solve the equation and then do what's rational, but that you also factor in the cost of solving the equation as a cost in deciding to do what's rational. And if the equation is too expensive to solve, too difficult to solve, then you don't solve it and you come up with some sort of shortcut. And they call that procedural rationality. I'm going to call these problems that I just showed you procedurally transcomputational problems. They're problems that you can write a solution down for, but we have absolutely no idea what that solution should be because we have no idea what you plug in to it. And so if you have such problems, then behavioral economics and behavioral finance increasingly are coming to the rescue and saying, when you're confronted with a procedurally transcomputational problem, people use heuristics. There are behavioral responses. We see something, we note characteristics of the problem, we remember other problems we've solved or we've seen other people solve, and then we do the same thing, hoping it will work. And we don't solve differential equations, and we don't solve for maximums, and we don't solve for IRRs. This is what we actually do. And behavioral finance, I think, has its strongest evidence back in financial history, which I'm growing to love as I get older. These are a whole bunch of books on the history of the stock market. Every one of them is worth reading. What they show is there are irregularly recurring stock market manias, panics, and crashes throughout financial history. And if you think about a stock market mania or panic or crash, stocks in 2000 fell by a huge percentage in less than a year. Did the intrinsic value of those companies really fall that much? Probably not. And the fact that that's just one of a long series of such things makes people think that stocks and stock markets especially are a good place to look for behavioral phenomena. So the history of stock markets, this is the first stock market ever set up in the modern Western world, the Amsterdam Stock Exchange, and it was set up because of the first high-tech boom. What was the high-tech industry? It was high seas shipping. So in Amsterdam, there were schools where they were training navigators how to use trigonometry, sines and cosines and tangents and log tables, and they were teaching them how to use compasses and sextants and things like that. And nobody else knew that. If you were doing trade from some other country, you kind of just had to hug the coast and never let the land out of sight, or you just get lost. But the Dutch could just go out on the ocean and sail. The Portuguese started this a bit, but the Dutch are really the ones that took off with it, especially with the mathematics. And so the high-tech workers of the age were these mathematically trained navigators. And here's the first high-tech stock mania. This is Dutch East India Company, stock company that trades spices between Indonesia and Europe. And there were other high-tech stocks, oceanic navigation stocks that listed as well. And the first secondary mania. And the secondary mania was in tulips. And this is the one that actually gets the attention of historians. The tulipomania in the 1630s, tulip prices went up and up and up and then crashed. And what was going on there? Well, here we go to Thorsten Veblen. Thorsten Veblen was a very interesting economist from the late 19th, early 20th century who came up with the idea of signaling theory and status goods. And what he argues is that as an economy becomes more unequal, the people who have become richer and richer and richer want status as well as wealth. And so they spend money on things to signal their status. Like nowadays it would be private planes or big yachts or whatever. But back then it was tulips. Tulips were this unique and beautiful flower that was very rare that had just come to the Netherlands from Afghanistan. They were brought through Turkey to the Netherlands. And the reason they're called tulips is actually kind of interesting. Tulip is from the Pashto or the Middle Pashto word Taliban, and Taliban means turban. And if you think about it, yeah, these are turban flowers. Okay, so here's Osama bin Laden. You just turn him upside down and he does kind of look like a tulip. So you can kind of see that. And tulips rose and rose and rose because people wanted status by having the best tulips, and then they crashed. And oceanic trading stocks barely noticed, and they just kept on going. And by the way, if you bought any of these portraits of tulips that were being painted during the tulip bubble, they are now priceless works of art, even though tulips are cheap. So next stock market mania of historical major importance happened in England, France, and the Netherlands again. And that happened after the Glorious Revolution of 1688, when the British merchants in the Netherlands sort of said to the Dutch, please invade us and get rid of our Catholic king. And they did. And all of this Dutch finance came to London. And so London then had stock markets, mostly in coffee houses. And there was an IPO boom where all of these new IPO stocks were being listed. There was actually the first special purpose acquisition vehicle where the prospectus said an undertaking of great advantage, but no one to know what it is. I'm not sure if that's apocryphal or not, but it's maybe too good to be true. But anyway, the big high-tech company was the South Seas Company, which was supposed to do oceanic trading. Here's how South Seas Company stock going up and then crashing. At the time, Isaac Newton was a retired physics professor who was in charge of monetary policy in England. He was master of the Royal Mint. And at first he told people, don't invest in this, don't invest in this. And then he saw his friends getting richer and richer. He bought a whole bunch right here. It peaked and collapsed, and then he sold out broke. And so we have this famous saying from Isaac Newton that you see in a lot of introductory economics books: I can calculate the motion of heavenly bodies, but not the madness of people. So I don't have enough time to go through all of this in detail either. 1820s and 30s, more high-tech booms in canals, 1840s, railways, telegraph. And by the way, after each crash, there's often a death knell for capitalism. So after the crash of 1847, we get the Communist Manifesto saying capitalism is dead. Crash of 1866, global financial crisis of 1867, Das Kapital, capitalism is dead. Crises and crashes in the late 1800s, early 1900s, the biggest high-tech boom in the 1920s with new home radios, electrification, power grids. IBM does its first IPO for adding machines. And then the crash of 1929, the biggest crash ever, 90% drop in the Dow. And that crash was worse than any other crash historically or since. And that's probably because there was a big trade war going on. There was an environmental crisis in North America with dust bowls. There was incompetent monetary policy, mostly in Britain, but also in other countries. And there were these bank runs. And so Ben Bernanke, who you may have heard of, actually is a financial historian. And his research is into what happened to the US economy in the 1930s. And he says that if the American government had bailed out the banks earlier and more generously in the 1930s, the Depression would have been a minor hiccup, not a Great Depression. And so when he had the chance, of course, he bailed out the banks first thing and generously, because that's what his research said. So then there's the anomaly, very few financial crises between 45 and 75. Increasingly, when I read about this now, people are drawing attention to the fact that Europe and much of Asia were devastated by World War II, and those 3 decades were actually rebuilding post-war devastation, infrastructure, buildings, highways, and companies, just rebuilding what was already there. And so you can have economic growth without creative destruction, without innovation, if your economic growth is rebuilding. And so if the cost of having another temps glorieux, what the French call this 30-year period of glorious growth, if the cost of that is having a world war first, then it's probably not a good trade-off. And then, you know, the stuff we're more familiar with, the dot-com boom and maybe the crisis of 2008, which may have been another secondary bubble, secondary to the dot-com bubble of the 1990s. So we can go back to this list of periods of rapid growth and innovation, and we can connect each of those, not perfectly, but often very, very closely to a stock market mania. And so this is something Kindleberger, Charles Kindleberger, drew attention to in his book, Manias, Panics, and Crashes in 1978. And what he argues is that we have a Kindleberger cycle. We start with a kind of a baseline economy where we're kind of in equilibrium, profits are zero. Then there's a disequilibrium. There's a new technology. Personal computers come into the world, and then all sorts of people figure out uses for them, Walmart and everybody else. And there's a huge capital inflow as people say, hey, there's huge IRRs in this industry. I want to get into this. And investors start getting high returns on their stocks, and they pour money into the stocks. Then there's a bubble where where the money pouring into the stocks boosts their prices, which makes the returns even higher, which draws even more money into those firms and those industries, which boost their prices even more, and the prices kind of rise up and up and up. And then there's something called the Minsky moment, and that's named after Hyman Minsky. What Minsky observes is that when stock markets crash, there's often no real news at the time. And so the Minsky moment is kind of the roadrunner runs off the cliff and he keeps on running out into the air. And then when he looks down, suddenly he crashes. And it's not really that anything happened, he just looked down. And so the Minsky moment is when the shareholders look down and the market crashes. There's a panic and a crash. There's a cleanup, bailouts, bankruptcies, and then you return to a baseline that may be at a higher basic prosperity level because now you've got newer, better production functions. And this is called the Kindleberger cycle in historical economic and business history circles. And that makes sense because these problems that we expect people to do are really quite insolvable. And so when you have rational decision-making being unsolvable, well, then you have to use heuristics. And what would those heuristics be? Well, there are all kinds of heuristics now in behavioral finance. There's kind of an industry of finding a new heuristic that you can find evidence for in the stock market. But two that I think are well supported is that we human beings are fascinated with shiny new things, and we also move in herds. If we see everybody else doing something, we do it too. And I suggest these as important, but there may be other things. So the literature on behavioral heuristics is that they kind of arise through evolutionary processes. We do something that works, or we see others do something that works, and then we file that, we remember it, and we repeat it. And so humans are attracted to novelties, and that kind of makes evolutionary sense, because if you're in a hunter-gatherer tribe and everybody's mostly starving most of the time, it makes sense to have one or two people try eating a new animal or eating a new berry. And if the people who die from eating these new foods are less than the people who survive because you find a new food source, then the tribe that does this is going to reproduce and survive. And that kind of behavior ends up being embedded in us. And we're also herd animals. If we see somebody else doing something, then we do it too. If you wake up in the morning, you look out your window, you see 10,000 people running east, what do? Sit down and do a differential equation to figure out what the right thing to do is, or do you grab your valuables and run east too? Well, it makes sense to assume other people might have solved the problem, and you should just do what they do. So what I think might matter here is that this might be important historically to two historical phenomena. One is Needham's question. Needham's question is, why did the Industrial Revolution happen in the West? Joseph Needham was a very highly respected student of Chinese technologies. And he's written a bunch of books about how unbelievably advanced the Chinese were during what were the Middle Ages and the Dark Ages in Europe. They just had a lot of stuff the Europeans didn't have. Why didn't the Industrial Revolution happen first in China? And then there's a second phenomenon called Cardwell's Law, which is that no civilization was innovative for very long. And if you look at the Chinese, that's actually true. They would come up with an innovation, but then the innovation would just kind of sit there for a long time. And then there'd be another spurt of innovation in the Northern Song dynasty, and they'd come up with other stuff, but they kind of just never did much with it. And the solution that many people point to is by William Baumol, and his reply is that in the pre-modern West, in Imperial China, Mughal India, the Islamic Caliphate, you didn't get rich by coming up with a new way of organizing inventory. You got rich by joining the Imperial Civil Service and getting kickbacks and bribes and moving your family ahead that way. And so since the 1600s, with stock markets and with business corporations and listed companies, you can actually get rich by doing high seas navigation or building a railroad or building a canal or making personal computers. And that's really only happened in the West. There really hasn't been a mechanism for getting rich in these other countries, no matter how smart they were. And so Baumol's reply is, in the West, You could get rich by innovating, and you never could anywhere else ever. Now, what I propose is that there may be another wrinkle on this, and it may be that we need not just the fact that you have stock markets and that you can get rich from innovation, but you need to get capital into these innovations. And chronically, we underfund innovation because innovation has huge social rates of return and very small IRRs, even for the innovating firm, mostly. And so if you have this Kindleberger cycle going, which periodically creates a bubble that floods new technologies with capital, then what happens is the people who invested in that bubble may lose money big time, but the economy has a whole raft of new production functions that bring the whole economy up to a higher baseline. And so what I suggest is that manias, panics, and crashes may be a way to compensate for chronic underinvestment in innovation. And in order for this to work, you need to have stock markets and speculation and finance and all of that. This actually may be a way to make Schumpeter's circular flow circulate capital into positive externalities in a way that wouldn't happen if people were really rational. And so my proposed friendly amendment to Baumont's reply is...
Excuse me for a second, Randall.
Am I running?
Lovely talk. We had, if you could take one more minute to wrap.
Sure. Yeah, I'm almost done.
That would be great. Thank you.
I'm almost done. Okay, so my proposed friendly amendment is that Kindleberger cycles actually might be important too. And whoops, that's not what I want. And so what we have is two market failures. One is chronic, severe underinvestment in innovation. The other is the mother of all market efficiencies, these tech bubbles every once in a while. And maybe in that, there's a secret formula for prosperity, that these two wrongs make a right. Yeah. And I am wondering if there might be a kind of an overstatement of the cost there, because if you didn't have the mania and the crisis, then GDP growth might be altogether much lower. And so the cost of not having crises, if it's also the cost of not having manias, might actually leave everybody worse off. And Alan Greenspan says there were no bubbles in the USSR. And I was fortunate enough to be a visiting student in the USSR in 1977, and this is kind of what it looked like in 1977. These are real things in the real Soviet Union in 1977. Their factories, their businesses were industrial museums. And so no bubbles, no innovation. Well, no bubbles in Ming Dynasty China either, or in Song China, or in the Roman Empire. So my tentative conclusion is that Samuelson is right about the stock market having predicted 9 of the past 5 recessions. And he brings that up because it's a way of sort of poking fun at people who use the stock market as a leading indicator. But there's maybe good news in that. You can have stock market manias that aren't followed by recessions. And you can have some that are followed by deep recessions or depressions. What's the difference? So the big difference historically is that a mania that's followed by a really big crisis is one where people borrowed a lot of money to invest into the mania. So in the 1920s, people borrowed money to buy stocks. In the 1990s, they didn't. And so when the stock market crashed in 1929, the banks were really deeply affected. In 2000, they weren't. In 2008, the bubble had been in real estate, which was financed by the banks. And so there was a big crisis. There's also a literature about accompanying regulatory cycles where politicians deregulate when there's a mania because they think that makes them popular. And then they put really heavy-handed regulations after the crash, which often makes the recovery more difficult. So is there a way to blow better bubbles? What's the social benefit versus the social cost of having debt flow into a mania? You do get more money flooding across new technology in the 20s because there's borrowed money as well as money in people's actual wealth, but you have a bigger social cost because you have a bank crisis afterwards too. And so there are just a whole bunch of unknowns here about corporate governance when there are positive externalities. What should we do? Should corporations go off and lose money to do research? How do different innovations in corporate governance, ESG, CSR, how do they play out when the externality is positive, not negative? And are there different corporate governance systems in the world that get this social trade-off, positive externalities, cost versus benefits, better or worse? What is good corporate governance when you know the market is in a bubble? What is good corporate governance when you're in a crash? In a bubble, should you be investing in R&D, even though you know you're going to lose money, because that's the socially good thing to do? So just tons of research questions that I'd love to see explored and that I just can't do. So my concluding slide, capital inundations are messy, and is there a way to do flood control in these capital floods? Egypt used to have the whole country flooded every year when the Nile flooded, and then they built the Aswan Dam, but the cost of that was they had to use chemical fertilizer because the Nile had fertilized Egypt for thousands of years, and it no longer did after the Aswan Dam. Could we have capital flood control? Could we manage the capital flood across high-tech sectors better, or is the best we've got the idea of Kindleberger cycles and these capital floods that are motivated by people getting excited about shiny new technologies, whatever they are, and pouring money into them? Are we just kind of lucky that that happens? So history doesn't repeat, but it rhymes, Mark Twain's. Those who don't know history are destined to repeat it, Edmund Burke, and a bloody good thing too, Sir Humphrey Appleby. So thank you very much. And of course, I may be wrong. And please let me know if I'm not citing somebody that I should. Sorry, I went a few minutes over.
No problem. Thank you so much, Randall. That was a fantastic presentation. Lots of claps around.
Great,
I want to be mindful of people's time. So that we got 3 questions in the chat. I'm going to condense it to 2 and just throw it out to you, and you can respond however you'd like. So the first 2 really focus on SRR, and basically the genesis of the question is just, if firms really did do as you're telling them to do, right, invest in more R&D for less return, wouldn't SRR fall dramatically to the detriment of society? And put differently, if SRR is consistently negative, who pays? So that's sort of the first question related to SRR. The second question ties in to what you just mentioned about just that idea of innovation, and the question is, how can we explain high valuations of R&D startups and the rush to finance them? So for example, Theranos, and could this just be due to irrational factors related to founders, broader market behaviors, rather than anything that's firm specific?
Sure.
So
let me answer,
back to you.
Let me answer the second one first. I think you're absolutely right that it is irrational, but that may be a good thing, because actually evaluating a technology is really, really hard. And so when we see a shiny new technology, Bitcoin or the internet or cell phones or automobiles or electricity or railroads, and everybody gets excited about it and everybody runs in for irrational reasons, we call them irrational. But what does it mean to be irrational when there's absolutely no way of solving what is the rational investment in something that's completely unpredictable, where most of the variables you'd put into the rational solution are unknowable? How can you say that pouring your money into internet stocks is irrational if nobody has any idea in 1996 what the actual value of the internet is? Now you could say, well, stocks are just way too high, but how do you know that? And how do you know when the bubble will keep going up and when it will stop? So it may be that what we've got is a system of institutions that foments a kind of irrationality, if you like, where there really is no possibility of being rational, and that works out well historically for countries that adopt those institutions. The first question, social rate of return, if you did more and more R&D, you would do R&D with lower and lower and lower social rates of return. And at some point you'd get to R&D with a social rate of return that just covers its social costs. And similarly, in negative externalities, if you tax pollution, you'd reduce pollution and reduce pollution and reduce pollution, and you'd get to a point where the cost of reducing pollution even more wasn't worth the distortion of having the small amount of pollution that remains. So one of the things they love to say in public finance is the optimal amount of pollution isn't zero. You don't reduce pollution to zero, no matter what the cost. You stop reducing pollution at some point when it's at an acceptably low level. And you can think about that when you're driving, right? If we wanted to reduce traffic deaths, we would ban left turns because a lot of people are killed doing left turns. But if you tried saying, we're going to ban left turns because it would save a few lives, people would get really upset because people like doing left turns. They don't want to have to go around a block to do a left turn. They want to just do their left turn. And what that means is people accept a very small probability of dying from doing left turns because it makes their lives simpler. Same thing with negative externalities. We accept a little bit of it. Same thing with positive externalities. We keep on subsidizing them, but at some point, the cost of the subsidy system and the tax system isn't worth the additional innovation that we would get. And so you should stop at that point. But what the literature says is we're way below that with innovation. We really, really, truly do way too little innovation. And if we had bigger stock market bubbles and more capital flowing into them, or if we had a better way of targeting capital, flood control, so that it gets to the most socially productive innovations, then maybe we would be much wealthier and much better off. Maybe we would have cured cancer, or we would have lightweight batteries already. Innovation really matters, and it solves a lot of other social problems.
Well, one could say that the COVID crisis really helped us speed along the innovation when it comes to mRNA technology. So maybe that's a good example.
I think that's true. And it wouldn't surprise me if we have a biotech bubble going forward. And that might be a very, a bloody good thing.
And I guess one potential takeaway from this is just embrace the chaos. If chaos is going to be there, then there's no use sort of fighting against it and resisting it, especially when it brings some benefits.
Some chaos. This particular kind of chaos, these particular behavioral phenomenons of being attracted to shiny new things and then hurting to do what other people are doing. If those are the things that come together to do this, I mean, there's one of the things the historians ask is, we do this over and over again. We've been doing this every 10 to 20 years since the invention of the stock market in 1600. Why don't we put laws and regulations in place to stop it? And the answer is, if we did, we might fall behind countries that don't put those regulations in place. Because having this behavioral phenomenon going actually might be good for a country. It might fuel prosperity. It might make the country bigger and more powerful and have a tax base capable of supporting the Royal Navy. And countries that don't have this just fall behind. So there are kind of geopolitical issues here too.
Right. I mean, there's that phrase, right? In the Chinese character for crisis has one component for danger, one component for opportunity, and that's really this the kind of like the ongoing theme that's going on. Okay, I have learned so much. Thank you so much, Randall. This has been fantastic. What a way to start off our webinar series.
Thank you.
So another round of applause, please.
Thank you, Professor Judge, and thank you very much to the Society.
Absolutely. So to everyone else, we have recorded the seminar. We will be making minimal edits essentially, and then sending out the YouTube link to everyone who registered. We invite you to please participate in our ongoing seminar. The next one will be early March 5th, I believe, and we'll be focusing on board diversity. So hope to see you all there. Please spread the word to all your friends and colleagues, and have a great rest of the month.
Excellent.
Cheers to 2020.
I look forward to it. Thank you.
Thank you, Randall.